You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the network where we welcome on guests from throughout the world of options and derivatives and indeed beyond, and proceed to pick their brains for the benefit of you, the listener. And next up on the program is old friend of the network, even though he hasn't been on, at least in person, in a while. We did have him on virtually about a year ago, but I'm pleased to be joined once again by John Davidson, the CEO over there, the Options Clearing Corporation. John, welcome back to the network. Welcome back to in person. You and I haven't done this in, 3 years in person?
It's fabulous to be back, and thank you, Mark. I really appreciate all the things you do for our industry and particularly for market participants.
Well, I appreciate your appreciation, sir. Thank you very much. But yes, there's a lot to catch up on. You and I chatted virtually last February. That's the last time you've really checked in with OCC. And obviously last year, a bit of a wild, crazy, unprecedented, pick your adjective of choice, and it probably applies to last year. So let's start there. Catch us up from your perspective running OCC during what was arguably the craziest year in the options market history. Catch us up there. What were some of your thoughts? What was it like over the course of the past year for you folks over there at OCC?
Well, it's interesting that, as you say, the most wild and crazy year in the history of the almost 50-year history of exchange-traded options happens while we and a large segment of the industry are all working remotely. And that's really a testimony to the work we've done to prepare and the work our colleagues throughout the industry have done to prepare for that. Certainly, we had record volume in 2021, and very happy with that. We also set a record open interest. More than 500 million contracts of options were open at a point in time in October of last year. Total 9.93, just shy of 10 billion options contracts traded. We seem to be on a pretty good path for 2022. Probably not necessarily right at that record level, but if you think about April of 2022, the month we just got through, compare it to 20 years ago in 2002, which is when I first went on the board of directors of the Options Clearing Corporation, representing Morgan Stanley. We traded the same amount of volume in the entire year, about 790 million contracts in 2002 that we traded in the month of April. So while certainly a lot of conditions in the marketplace have changed, and I think that's another important characteristic of the need for options education. We have a whole generation of investors who haven't really seen a bear market, haven't really seen inflation as the predominant characteristic of the U.S., if not the global economy. So all of these changes, people really need to understand these instruments are risk transfer instruments. They have their own inherent risks that you need to understand. We've been making a lot of investments at OCC, of course, first and foremost, to make sure that we can handle the capacity that the industry throws at us. This is a really interesting conference we're at because there's always an introductory, what's the market doing these days? And the volume in the options industry looks like a hockey stick over the last 2 years. It's truly remarkable how much it's increased. We have a 22-year-old clearing system at OCC, but it is very, very resilient and hasn't had any problems handling the capacity whatsoever. We've been previously focused, of course, on how we manage the risk in the market as a whole. And I would say one of the things that changed most dramatically in 2021, not that it hadn't happened before in history, because there's certainly a number of prior incidents like the boom in technology stocks around the turn of the century and things like that. But idiosyncratic risks of particular instruments, the so-called meme stocks, but a variety of stocks, single name equity options, growth really expands dramatically. Growth in exchange-traded funds expands dramatically. And how our margin rules and our margin models handle those tremendous changes in volatility in particular have been very well tested in 2021. We continue to make investments in those models, obviously subject to regulatory approval for the changes. But I would say overall, the industry in general and OCC in particular came through 2021 very well. And we're now in at least recent history, relatively unprecedented times. We've seen a lot of very dramatic changes in levels of the market, both individually and collectively, and I think we're well positioned for that.
Well, a lot to unpack there, John. I think we'll start right where we left off pretty much last time you and I chatted. It was February of last year. We were just in the infancy, the early days of what would come to be known, as you mentioned, the meme stock explosion. We were seeing, it seemed like almost on a daily basis, things occurring in the marketplace that we were taught that when I first walked on the floor were probably impossible, or at least highly, highly improbable. Things like large trading names going up to 1,000% implied volatility and trading there for sustained periods of time. So it seemed like every day we were getting something new, something unprecedented thrown at us. And for you on the clearing side, it must have been equally challenging. So walk us through that year. As we look back now, we have a whole year behind us of this meme stock explosion. Were there any interesting takeaways or maybe lessons learned or just surprises you had on the clearing side? You said, wow, we never anticipated that unfolding the way that it did, that you can now look at and learn from going forward.
Well, I don't think there were any unpleasant surprises per se. I think the industry handled the increase in volume and the volatility very well. I think we need to be careful about making sure that all the new investors in these products have a good understanding that the market does both go up and go down, and that you have to understand the positions that you're putting on a little more rigorously than maybe people thought when it seemed that the market only went in one direction, which is generally perceived to be positive. At the OCC, of course, we have had very high levels of volatility, but again, a fair amount of variability in that volatility. So it's not like the entire market is volatile all of the time, but there are certainly, particularly single stock options, where the mix, and as you mentioned, the so-called theoretically challenging levels of volatility changed fairly dramatically. But again, because we have a risk system that's based on stress testing and looking at extreme but at least plausible changes in levels of price, we were well prepared to handle those. And it would appear that our clearing members have been well prepared to handle those. So I think that's certainly good news. The other thing that is very important to understand is the role of the capital markets in the U.S. In the last 2 years, there have been more than 1,500 new issues, new initial public offerings, and derivatives of initial public offerings box that have come to market, and we have options on a very large number of those IPOs. So it's very clear that the capital markets in the U.S. are responding to all the developments in the economy, the new opportunities that entrepreneurs have to develop new ideas, bring them to market, see if they succeed, and if they succeed, bring them to the public capital markets. And the options markets really support all of that activity. We need to make sure that persists, both from our role as sort of the foundation of secure markets, providing the infrastructure, the plumbing that most people don't pay much attention to for most of the time unless something breaks. Nothing broke in 2021, and we don't have any expectation that it'll break in 2022 based on what we've seen so far.
Yeah, the offensive lineman of the options market. When they call out your name, it's usually because of something bad, right?
That's exactly right.
Well, one of those things I wanted to touch on a little bit, and the risks you mentioned earlier, John, because there was an interesting debate that emerged, particularly within this audience, the industry and institutional audience last year, which kind of surprised me, and I wanted to get your take on it a little bit. When we saw this massive wave of retail coming into the marketplace, for the most part, they were doing one trade, which was buying calls on whatever name it was. It was very one-sided paper over and over again, which led to these explosions in call volatility and upside crashes and all these names. And we started to hear this persistent drumbeat right around the time you and I chatted February last year, that, you know what, maybe we're doing this wrong. Maybe we're systematically, as an industry, pricing call options wrong because they were never designed, our models were never designed in the wake of this massive influx of new demand for one type of trade and one type of trade only. And so I started to hear a persistent drumbeat from people, even very sophisticated people in the industry. You know what? Maybe we need to rethink the way that we are pricing call options in the wake of this tidal wave of new options paper. Obviously, you over there at OCC, you mentioned your risk models. You're kind of the risk modeler in chief for the industry over there. I'm curious for your perspective. You had no major issues, so it sounds like everything worked out from that perspective. But what are your thoughts on that debate? And were you surprised, like I was, that it was as heated and as contentious and as widespread as it was, that we as an industry were perhaps doing it wrong, John?
Yeah, I don't buy into that argument particularly well, I'm afraid. It is true that we had a strong predominance of retail investors in call options. On the other hand, protection of puts was seen as an important thing, particularly for institutional investors, making sure they could hedge their exposures in a number of areas. This past couple of months has changed, I think, the orientation of the market, and people are starting to think about more defensive strategies. At the end of the day, we're really not the risk managers and the arbiters of prices. That's the options market makers. Unlike the cash equity market, where really the marketplace is bringing buyers and sellers together, and the options markets, virtually well over 90% of the retail order flow has a market maker, a professional market maker, dominated by half a dozen or a dozen large firms who are dedicating the capital. We now have 1,600,000 different strike prices in options, and the market makers are obliged to make markets in that entire portfolio for the most part. So they are really setting the prices in response to what's happening in the marketplace. And I think they do a very good job of that. And they have the intellectual and the technology horsepower to make those markets in a pretty continuous basis. Now we're starting to talk about more 24-hour trading in the options industry. It's a really interesting emerging topic. It's somewhat straightforward, I think, for index options and some of the big name exchange-traded funds, options on exchange-traded funds. It's a bit more challenging if you think about 24-hour trading on single name options on specific securities where the underlier may not trade during all of those 24 hours. But I think the markets are efficient. They're not 100% efficient, but they are quite efficient. And the market makers just do an awesome job. There is strong competition among market makers. If they were mispricing things in a systematic way, the market simply would not operate, and we wouldn't see the kind of volume that we've seen in 2021 and year-to-date in 2022.
Well, you mentioned extended hours trading, John. There are two questions I am legally obligated to ask you whenever you come on, John, because our audience asks me so often that I have to relay them to you. One of them is along those lines. It seems like usually at this time of year during earnings seasons when we receive this inquiry the most, but a lot of particularly new traders to the options market, they look at stocks, they see after hours in stocks, and then they look at options around earnings and they say, why isn't there an after hours or extended hours session for options? You mentioned we are starting to see some pushes towards that. What are your thoughts overall on extending those hours, whether it's in single names or in the indexes? Do you think we're heading there anytime soon? And perhaps are there any unintended consequences that may have on the marketplace going forward?
Well, I think, a number of the exchanges have had slightly extended trading hours, particularly for index options, for some time now. They are not wildly successful. I mean, certainly if you compare the, if you will, overnight after the close options volume to what we see in stock index futures and other U.S. futures contracts, our numbers pale in comparison to those. But I think there's more and more appetite for in the index option area, in particular, in ETFs like the SPY, to trade longer hours. We're moving to or at least we have a commitment to move to a T+1 settlement environment for cash equities. A couple of years away, a lot of work to be done. Obviously, options have settled T+1 since inception in 1973, but it's a huge transition. And I think as the international participants in our markets become more sophisticated and more active, they want to have some availability of markets during their regular business hours, which means after hours or before hours in the case of the U.S. markets. But it becomes very challenging when you think about something where the underlying is not trading. So there's very strong correlation between the index futures, which, as I mentioned, do trade pretty well 24 hours a day, 5.5 days a week. Maybe there are 24 underlying equities that there's some activity in after hours. There are a number of challenges related to financing. Fedwire, of course, is open from 9:30 at night until about 6 o'clock in the afternoon. So you can actually move money around. People previously thought that was an impediment. Challenge is the banking system doesn't really have financing coverage during all of those extended hours at this point in time. So I do see, and obviously from the perspective of OCC, we have no issue in processing as whatever hours people trade. But I do think we will see more activity for the largely popular index options and a limited number of ETFs, but I think it'll be at least a couple of years before we see any sort of significant volume in the fungible single name options. That's just a guess on my part, but I think there are a number of impediments to that currently.
So SPY and SPX in the near future, Apple and Tesla probably down the road a little bit.
That's what I would imagine, yes.
The other question, John, I am legally obligated to ask you is we have a lot of new listeners coming on, and they're used to putting up their trades, and their trade is executed in microseconds now, right? So their execution experience is very quick, very robust, and they like that. And maybe they're trading on the crypto side where they see a lot of quick trades as well. And then when they look at starting to track the trades in the options market, and then they realize, oh, the open interest doesn't change until doesn't update except for once a day. So they always ask us, why can I execute a trade in a fraction of a second and then it takes a whole 24 hours for that OI to update? I know you and I have chatted about this before. You've been working on some of the infrastructure. What do you want to say to our listeners who maybe are curious? Will we see perhaps maybe even like a midday update for OI going forward, or something to extend or perhaps accelerate the 24-hour refresh that we have now?
So there are a couple of impediments to that. One is technology. We are currently in a largely batch-oriented environment, and we publish open interest for all 1.6 million strike prices at the same time, as you say, once a day. We are in the process of completely rebuilding our technology. The so-called Encore clearing system, which has served the industry very well for 22 years, is going to be replaced by a much more modern, much closer to real-time system that we've now determined will be called Ovation, because you always have an ovation after an encore. Before an encore as well, but can't go back in history. So Ovation will give us the ability to do this pretty seamlessly. But there's another piece of the puzzle, and that is in every options transaction, with the exception of the market makers who are about half of the volume, but they're always net. We need the investors, broker-dealers, the executing brokers, the clearing brokers, to tell us whether a particular transaction is to open a new position or to close an existing position. And unless you have a good handle on those so-called open-close indicators, you don't really know what the open interest is until after the close. There are a number of things that are increasing the ability of the industry to provide us more timely open-close indicators. And it's not so much a retail investor issue, because the retail investor essentially knows what he or she is doing prior to execution. It's particularly important for large institutional investors who are doing a set of block transactions for multiple beneficial owners. And across those multiple beneficial owners, some may be open, some may be closed. So if I did a 5,000 contract transaction for a set of managed accounts, it's not until after execution and I break down that block into the individual beneficial owner accounts that I really can say what the open or close was for each of those constituent transactions that made up the block. So it's those kind of complications that aren't really technology per se, but a little more, if you will, business practice that impede an accurate open interest calculation on either a real time or a multiple time during the day. But I think everybody understands the benefit of that. Certainly if you think about market makers who are, the most real-time focused risk managers in the industry, they're always on top of what their net position is, what was opening, what was closing, what they're going to try to hold to maturity, et cetera. So it's doable, but we have to change some fundamental business practices and get better data at the offset. I think everybody is of a mind to get it done. It's a question of when reality will set in and we'll be able to answer those questions. You really do not want to publish inaccurate open interest. That would not be a service to the investing public, I don't think, at all.
It's the first do no harm principle of clearing. Well, you mentioned your Ovation technology platform overhaul. You guys are in the midst of that right now. Give our listeners some insight into that. What is the time frame for that, and what are you looking to upgrade under the hood there, John?
So we're really upgrading the entire infrastructure. We currently have, as I mentioned, a batch-oriented mainframe dependent architecture, which is very resilient and very volume insensitive. It hasn't had any trouble at all handling the hockey stick in volume, but it's not particularly flexible. It takes us quite a while to support new products that exchanges come up with. It doesn't give our clearing members the level of service that they and we would like. So among the things that we will do relatively early is provide the ability to do so-called what-if margining. So I'm a clearing member. I'm going to get a new customer in. She's got a big portfolio. I want to understand what that portfolio is going to do to my overall customer clearing omnibus account. Send all of those positions into us, and we will give you what the margin would look like if, in fact, you took that portfolio in and applied it to your overall clearing portfolio at the customer level. Other CCPs around the world have the ability to do that. We don't yet. We hope that will be an early 2023 implementation. We'll be publishing all of our new changed interface requirements, which we're trying to minimize in the middle of this summer. So all of our clearing members have the lead time to do their own development prioritization so that when we start testing in 2023, I have about a year of testing to do with clearing members. When you make this fundamental a change to our underlying technology, they'll be ready to go. We changed not only the clearing interfaces and make everything more real time. We will be implementing, after we go live, a series of so-called APIs, so that instead of going into a terminal that's connected into the Encore clearing system, you just send us your data, receive the data back, put it into your own format, much more flexible than the current environment. We're changing the whole architecture of our risk and margin calculations. All of this will be so-called code complete, so the actual development will be finished toward the end of the second quarter of 2023, and then we will move into this rigorous testing process. Obviously, we're testing now as we get particular components built, but you have to test the entire system as it works together, and you have to test all the weird things that have happened in the market. The stock market crash in 1987, the meme stock issues in 2021, all have to be brought through that new environment. So it's going quite well. As with any other big technology project, it ebbs and flows, and certain parts get behind, and certainly the marketplace for technology talent right now is quite challenging, and we're hiring. We have a number of suppliers that help us out in that regard, and overall, we have, I think, good success from developing the core fundamentals of what we need. But a big piece of what we want to do, in addition to just changing the software, is changing the environment in which that software runs. And that's a move to the so-called public cloud. And to do that, we need to have regulatory approval. After the Dodd-Frank Act, there's a process known as the advanced notice process, where if we're going to significantly change the risk profile of the OCC, and it doesn't matter whether we're going to make it significantly better or something might make it significantly less good, we have to request regulatory approval from the Securities and Exchange Commission as well as the staff of the Board of Governors of the Federal Reserve System. We have, in October, made a formal filing to move our processing environment to the cloud. We think we get a lot more resiliency from the way public cloud architecture is designed. We'll be in 2 different regions of the cloud provider's environment, in 3 different so-called availability zones within each region. So essentially 6 levels of backup that can be implemented very, very quickly. And then to make sure we don't have total exposure to a single provider, we have our own data center, which will really be the 7th level of backup in the event that the cloud provider goes down completely for some reason. It's never happened, but we have to manage fat tails as a CCP. We've been very proactive with the regulators they've asked us a lot of good questions. We've made some modifications to our proposal in response to those questions. We continue to work with them. And we should, towards the first week in July, have a response from the regulatory authorities as to whether they're going to be comfortable with us moving to the cloud or whether we're going to have to stay in on-premise so-called data centers. The challenge with that is because of the supply chain issues, we would need to start building out an additional data center for these purposes if we're not going to the cloud, and order all the hardware in the late part of the summer, around the first week or so in September. So there is some time criticality with respect to that. But so far the process is going quite well. So like any other big technology project, as I said, there are bumps in the road. And you have to manage those bumps in the road. We try to be very transparent with our clearing members about minimizing the effects on them, understanding from the exchange's perspective what their needs are. We're in the not too distant future going to have a 17th option exchange in this in our industry. So all of these things are quite challenging to continue to manage, but we've got a really good team of people and get very, very good guidance and oversight from our board of directors.
So hopefully, John, by the time you and I sit down together at this conference next year, we'll have more insight into how the Ovation platform is rolling out, John.
Absolutely, we will.
And I want to circle back to something you said earlier in our conversation about volume. One of the questions we've been polling everyone on ever since this pandemic kicked off and the volume, as you mentioned, the hockey stick started shooting north there, certainly coming into 2021. And again, this year, we've been polling a lot of our guests and our regular co-hosts about whether they think this volume explosion can continue. And certainly for last year, as you mentioned, it did. It hit nearly 10 billion contracts there at OCC. But it sounds like from your comments earlier, you don't think we're going to hit that close to 10 billion level again this year. I'm curious why you think that and what kind of volume numbers we'll be looking at for this year, John.
Well, I think we'll be pretty close, but I think we will not have the sort of double-digit growth in volume that we've seen the past 2 years. That's not necessarily a bad thing, actually. But we see, and there have been a couple of panels on that at the conference here, more return to the market by institutional investors. That's certainly a positive thing. And retail volume is not increasing at the rate it was, but it's not exactly vanishing either. So I do think we are going to see an era of slower growth, but I don't think we're going to see the kinds of declines in volume that we saw in the financial crisis. There's a lot of risks out there, And these are very useful risk management products that risk transfer products that the options industry has and continues to develop. I don't think we'd have a 17th options exchange moving into the market. I mean, got a perfectly fine franchise in cash equities. You don't move into another more complicated market. They're going to trade all the fungible names. Well, they don't have quite all the 1.6 million strike prices to deal with, but they've got probably 1.3 or 1.4 million of those to deal with. All those, I think, are positive signs, but I would see growth slowing a bit. And we can see that. We had 260 million plus contract days on a successive Friday and Monday in January of this year. But we're in the sort of high 30s to mid 40s million contracts of late. And I think that's a good steady state for the industry. And of course, the volatility continues. I haven't looked at the market since we've been in here, but we had another day where we opened higher and are moving lower. And obviously, that changes from name to name with respect to the single stocks. But there's a lot going on, and some new phenomena in the economy with respect to inflation. Some new phenomena in the geopolitical world with respect to particularly the war in the Ukraine. And all of these, I think, make people a bit more conservative, a little less rah-rah, let's go out and trade, and a little more thoughtful about, what are the risks that I want to manage? What's the best strategy for protecting my portfolio against things that might happen that we hadn't seen in a few years.
Well, John, it's been great to see you face to face again. I appreciate you taking some time out of your conference here to fill our listeners in on the latest developments over there at OCC. But before we go, if there's anything you forgot to mention, or perhaps you've already given us some interesting teases, but if you want to leave our listeners with anything else, any interesting teases about what's coming down the pike from OCC, now is the time, John. The floor is yours.
Okay, I'll give you two interesting teases. One is, as I mentioned at the outset, I think the work that you guys do in terms of investor education is particularly important. One of the things we've done that we haven't been able to do for about a dozen years is we've completely rewritten the options disclosure document, the sort of fundamental prospectus that underlies and explains to investors all of the risks and the characteristics of these options. It's much more readable than it was. We need to move that into something that is consumable on your mobile phone. That is something we're working on, just making and collaborating with our clearing members and people like yourself to enhance investor education. There are an awful lot of new investors in this market. That's a good thing, but it's a better thing if they understand all the risks and characteristics of what they're trading. The other thing, of course, is there's now at least a preliminary thought that the underlying cash markets for U.S. corporate securities will move to a so-called T+1 settlement environment away from the current T+2. That does a whole bunch of interesting things in terms of how expirations work, how exercises work, when people have to have their order allocations in, and the linkages between the derivative markets and the underlying cash markets, which will occupy the industry's attention quite a bit for the next couple of years, just the financing consequences of thinking about that. It clearly reduces overall settlement risk, but we've got to make sure we're very thoughtful about how we get there.
I lied. One more thing, John, before we go. You mentioned expirations. We are seeing this push towards effectively daily expirations. We're already there in the SPX. We have a Monday, Tuesday, Wednesday, Thursday, Friday expiration. There is some interest/consternation at a conference like this about adding that to single names. Do we need to have an Apple expiring every day of the week, or Tesla? I'm curious, what are your thoughts on this continued proliferation of expirations?
Look, I think this is a pretty complicated topic. It's very straightforward for ETFs and for index options. The challenge with single names is there are corporate actions on single names. And do you really want to have a corporate action on exactly the same day as an expiration? And that's very challenging. Investment bankers get paid a lot of money to think of new and more elaborate corporate actions. Dividends used to be highly predictable. Now there are all sorts of special dividends that come out. Working through the challenges associated with corporate actions are the biggest non-cyber risk that OCC faces in terms of we have to make very quick, very correct, very timely decisions about how to adjust options for particular kinds of corporate actions. Having more expirations and more complexity around those, I think, is a challenge at this point in time. I'm sure the industry will be able to work it out, but it will take some time and some focus and concentration. So great for ETFs, great for index options where there aren't generally corporate actions, but challenging for the single names.
Well, John, I appreciate you taking some time out of your day to chat with our listeners, and we'll look forward to seeing how Ovation and all these other new upgrades over there at OCC, how they unfold in the marketplace in the coming months.
Great. Thank you for the time. Really appreciate it.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.